Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Manpowergroup Inc. Annual Report. Manpowergroup Inc. offers a diverse range of workforce solutions and services globally under its three prominent brands, Manpower, Experis, and Talent Solutions. The company's primary focus areas include recruitment services for various professional positions, such as administrative, industrial, and information technology roles. In addition to recruitment, the company provides assessment, upskilling, reskilling, training, and development services to enhance employees' skills and career management. Manpowergroup also offers outsourcing services related to human resources functions, including large-scale recruiting and workforce-intensive initiatives. The company's services extend to contingent staffing and permanent recruitment solutions, as well as information technology professional resourcing and project services. Furthermore, it provides recruitment process outsourcing, RPO solutions, and right management services through its TAPFIN Managed Service Provider solution. Unfortunately, I do not have access to the text you provided. However, I can still provide a general overview essay on what could cause a stock price to crash. The sudden and drastic decline of a company's stock price is often a result of a combination of factors. One major reason is poor financial performance, such as declining revenue or increasing losses. This can be due to various reasons, including inefficient management, failure to adapt to changing market conditions, or being unable to compete with other companies in the industry. Another possible cause is negative news and publicity surrounding the company. This could include scandals, product recalls, or major setbacks that damage the company's reputation and erode investor confidence. Additionally, changes in leadership or a lack of transparency can also contribute to a decline in stock price. Furthermore, external factors such as economic downturns, regulatory issues, or industry-wide trends can also impact a company's stock performance. In some cases, a single event or announcement can trigger a sharp decline in stock price, making it essential for investors to stay informed and adapt quickly to changing market conditions. In the case of Manpowergroup Inc., without access to specific information, it is difficult to pinpoint the exact cause of its stock price crash. However, it is likely that a combination of internal and external factors contributed to this decline. Manpowergroup Inc. maintains a market capitalization of $1 billion, broadly in line with the industry peer group. Manpowergroup Inc. trades at a lower price-to-book ratio of 0.59 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 74% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The company have a dividend yield of 5.54%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth are multifaceted. Revenues from services have been a significant contributor to this growth, as has the diversification of clients, with no single client accounting for a substantial portion of revenues. Furthermore, an increase in RPO contracts with multiple performance obligations and the recognition of revenues over time for certain client contracts have also played a crucial role. On the other hand, revenue decline is primarily driven by macroeconomic and local market conditions that have deteriorated. Additionally, financial performance has fallen short of management's planned expectations, leading to downward revisions in full-year revenue projections. These factors have had a significant impact on the company's revenue growth, particularly in certain segments. The Americas segment has shown notable growth, with an increase of $724.20, 21% growth, from 2024 to 2025. In contrast, some segments lack comparative data for the previous year, making it challenging to determine their primary drivers of revenue growth or decline. To improve transparency and facilitate accurate analysis, it is essential to provide comparative data for all sections and clearly state the primary drivers of revenue growth and decline, supported by evidence from financial statements and management's discussion and analysis, MD&A section. Net income experienced a significant decline between 2023 and 2024, decreasing by $158.4 million to minus $13.3 million. This substantial drop was also reflected in the net income per share, which decreased from $3.01 to minus $1.29. However, there was an increase of $56.3 million in net income from 2023 to 2024, indicating a brief stabilization before the decline in 2025. Profit margins also underwent significant changes during this period. The gross profit margin saw a decrease of 60 basis points and 180 basis points in certain regions. Operating profit margin decreased by 50.9% and 0.9%. Additionally, the effective income tax rate increased by 70.7%, contributing to the decline in net income. The reasons behind these changes are multifaceted. Decreased demand in key markets, material adverse impacts from regulations, restrictive contracts, special taxes, fees or costs imposed on associates, immigration regulations affecting cross-border business, and decreased profitability in the United States business all contributed to the decline in net income and profit margins. Furthermore, goodwill impairment charges also played a role in this significant decrease. The company has demonstrated a consistent ability to generate positive operating cash flow over the past few years. In 2023, it reported an impressive $348.2 million in operating cash flow, with a partial calculation also showing a significant amount of $14 million. This trend continued into 2024, where the company generated a substantial $309.2 million in positive operating cash flow. However, there is some discrepancy regarding the company's performance in 2025. While some statements suggest that it has maintained its positive operating cash flow, others indicate a decline to negative operating cash flow. Despite this inconsistency, the overall picture suggests that the company has been successful in generating positive operating cash flow for several years, indicating a strong financial health. The company's debt level and interest expenses have undergone significant changes in recent years. The debt level has increased substantially, with total debt rising from $952.8 million in 2024 to $1,677.1 million in 2025. This increase is largely due to the issuance of €500 aggregate principal amount of 3.75% notes due December 2030. Furthermore, net debt borrowings increased by $570 million between 2024 and 2025. Interest expenses have also seen a significant rise, increasing from $56.7 million in 2024 to $67.6 million in 2025. This represents an increase of $10.9 million, or 19%. Additionally, short-term borrowings and current maturities of long-term debt increased by $601.6 million between 2024 and 2025. Overall, the company's debt level and interest expenses have experienced significant changes in recent years, with a notable increase in both areas. The performance of various regions and segments in the market has been mixed. On a positive note, Southern Europe, Northern Europe, Asia-Pacific, Latin America, and the United States have shown improvement or strong performance. These regions have seen growth and stability in their respective markets. However, there are also some areas that have underperformed. The APME region, which includes Asia-Pacific Middle East, has struggled with declining trends. Additionally, despite showing improved trends earlier, the United States has experienced a revenue decrease, indicating a reversal of fortunes. These poorly performing regions will require attention and strategies to improve their market standing. Management's outlook on the company's strategy emphasizes the importance of adapting to changing market conditions. The labor market's strength affects demand for workforce solutions, but forecasting future demand is challenging due to economic factors. To mitigate this risk, management plans to continue building the Experis brand and attract talent as skills shortages arise. In response to potential economic downturns, management prioritizes long-term potential over short-term cost-cutting and acknowledges the need for speed, agility, and resiliency to operate the business. The company is also investing in transformation initiatives to improve operating efficiency and develop client offerings. Management expects revenue growth rates to continue in the future, but notes that adverse economic conditions in key markets could have a material impact on consolidated financial results. To adapt to these changing market conditions, management is focusing on providing innovative workforce solutions with higher margins, prioritizing people's health and well-being through flexible work models, and championing diversity and inclusion. Overall, management strategy emphasizes the need for adaptability, resilience, and innovation in response to changing market conditions. By investing in transformation initiatives and prioritizing long-term potential, the company aims to maintain its competitive edge and drive future growth. The company has made several strategic moves through acquisitions and divestitures. In terms of acquisitions, there is no mention of any significant transactions in various pages of the report. On the other hand, the company has undergone several divestitures. One notable example is the disposition of businesses in South Africa and New Caledonia, which is scheduled to take place in 2025. Additionally, the company has also disposed of its businesses in South Korea and Austria in 2024, as well as in the Philippines in 2023. Furthermore, there are mentions of specific divestitures, such as the disposition of the South Korea business within the APME region, which is recorded on page 32. The loss from the disposition of subsidiaries was also recorded in 2025, as stated on page 35. Another notable example is the wind down of Proservia Germany, mentioned on page 86. Overall, these divestitures indicate that the company is streamlining its operations and focusing on specific regions or businesses. The company's financial activities have been focused on rewarding its shareholders through various means. One of the key strategies employed by the company is paying dividends to its investors. This move not only demonstrates the company's commitment to its stakeholders, but also provides a tangible return on investment. In addition to dividend payments, the company has also engaged in share buybacks. By purchasing back its own shares, the company aims to boost shareholder value and potentially increase earnings per share. This strategic decision reflects the company's confidence in its financial performance and its desire to create long-term value for its investors. There are valid concerns about inventory buildup or supply chain disruption. Several factors contribute to these risks. Disruptions in the global supply chain can occur due to various reasons such as energy supply instability, heightened cybersecurity threats, foreign exchange rate volatility, and potential government retaliatory actions. The company's reliance on third-party vendors also increases the risk of supply chain interruptions. This is because system failures, computer viruses, natural disasters, unauthorized access, cyber attacks, and other similar incidents can occur, leading to disruptions in the supply chain. Furthermore, cyber attacks and supply chain interruptions are mentioned as potential risks that could lead to significant consequences for the company. In light of these concerns, it is essential for the company to develop strategies to mitigate these risks and ensure a stable supply chain. This may involve diversifying its vendor base, investing in cybersecurity measures, and developing contingency plans for potential disruptions. By taking proactive steps, the company can minimize the risk of inventory buildup or supply chain disruption and maintain business continuity. That concludes the financial summary for Manpowergroup Inc. Feel free to comment below, and I will be happy to answer them when possible.